Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. As a real estate investor, it is your mission to find out what's going on in your marketplace. We're going to talk today about how you can spot trends, what that means to you, and you're going to get some great information from an awesome guest today on the Real Estate Guys radio program.
Hi, this is Patrick Donahoe, CEO of Paradigm Life. Wall Street and banks spend billions of dollars per year in advertising with the goal to convince you that they are the solution. But take a look around. None of their advice has worked. If you're listening to this, odds are pretty good that you're already a real estate investor, or at least becoming one. So why do you do it? Is it to hedge inflation, the tax benefits, or maybe it's to get your money away from Wall Street? It's because of these benefits and so many more that I created the Real Estate Investor's Guide to the Perpetual Wealth Strategy. When you combine successful real estate investing with the Perpetual Wealth Strategy, you have the recipe for what has helped the wealthy to establish their financial well-being for decades. You can download the Real Estate Investor's Guide to the Perpetual Wealth Strategy today by clicking the Resources tab on the Real Estate Guys Radio homepage. Don't wait, go download it now.
Welcome to the Real Estate Guys radio show. I'm your host, Robert Helms, finally back on dry land. With me, it is the co-captain, Russell Gray.
Hey, Robert.
A couple of shows from the summit, which were amazing. All those folks crammed into a couple of shows. And if you've listened the last few weeks, then, oh my gosh, you're probably on the kind of overwhelm we were on for 11 days. But things have settled down a bit, and we're here to talk real estate.
Yeah, it's really interesting how the Investor Summit at Sea has evolved into this big investor conference. But at its core, I mean, we're real estate guys, and we really think real estate should be at the core of anybody's financial program. You know, you can do anything with real estate that you can do from a financial planning perspective with paper assets. And so a lot of the financial planning techniques and some of the asset allocation and risk mitigation models and things that you have that a lot of financial planners use with paper assets, you can actually apply those very same principles to your real estate. And then you build off from that. And then we talked a lot about commodities and all that different stuff. But at the end of the day, everybody, whether they're investing in real assets or paper assets, is always trying to figure out which way is the flow going. You want to be in the flow of capital. The old adage is the trend is your friend. Today's show, we're going to be talking about trends and how a real estate investor can look at those.
Yeah, and depending on the type of investment you typically make in real estate, if you're a single-family home investor, well, we're going to talk primarily about those trends today. So what we're seeing in terms of single-family demographics and so forth. But you see trends in every type of real estate. We spent a lot of time on the summit talking with and about folks in the agricultural space. Well, there's certainly trends there. I mean, how much kale was grown 10 years ago?
Right.
And so that's a
or
trend.
Organic.
Or even organic. That's another huge trend. A lot of trends when it comes to that business. Retail. The trends in retail have changed tremendously.
You think?
Yeah, in the terms of how people are buying. And so as a single family home investor, you might think, well, there's not that many trends that apply to me. Well, you're going to learn otherwise today because we've got a great guest for you. In fact, his claim to fame is that he is in several single family markets. He's an educator and continues to educate folks, which we love. But he's very active in markets, and his clients range from mom and pop investors all the way up to hedge funds.
Yeah, this is really interesting because not everybody can deal with people who are operating at a high level. You know, a hedge fund guys, Warren Buffett is not a hedge fund manager, but a big fund manager. And he said, hey, if I could find a way to buy 200,000 single family homes, I would. Instead, he went out and bought a bunch of Wells Fargo so he could get in on the mortgage side of it. He started Berkshire Hathaway Real Estate Brokerage so that he could get in on the brokerage side of it. But the actual bread and butter of owning income producing single family homes, that's got a lot of hair on it, at least for a guy like Warren Buffett. But there were a lot of hedge funds, a lot of fund managers in Wall Street that saw the opportunity, that raised the money, and they needed to go out, and they're used to being able to place orders in bulk. They're used to being able to go out and just place an order for 1 million shares or 5 million shares or 100,000 shares or whatever it is. And you don't just dial up single family homes like that. There's a process. Now, the dark side of what went on in 2008 is a lot of people became disenfranchised, if you will, from their home. A lot of people went from being homeowners to being renters, which of course was very good for landlords, and a lot of the money wanted to be on that side of the transaction. But on the flip side of it, it created a lot of opportunity, right? For people who are saying, hey, I want to be an owner of that. And how can I do that on a big scale? So when you meet a guy who can talk at that level with someone who is managing hundreds of millions of dollars and needing to make big deployments and yet be able to operate at a tactical level, because in all businesses, the money is made at a tactical level. And real estate of all businesses, I mean, the most important person is your property manager, right? So the guy we're going to hear from today does both overseeing the acquisitions. He's dealing at the big level with the hedge fund guys, big money guys. He's dealing with mom and pop investors in a completely different set of issues. And he's also very much involved in the hands-on of actually acquiring the inventory, getting it rehab. I mean, he may or may not be swinging a hammer at this stage of his career. I'm guessing he's not. But being able to really understand the whole thing top to bottom. And that is really rare, which is why we're excited to talk to this particular guy.
He spends a lot of his time researching, and what we're going to learn today is some of the recent research he's done on hot trends in demographic and single-family rentals. We come back, you'll meet Aaron Adams today on the Real Estate Guys radio program.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Memphis is famous for being the home of the king of rock and roll, but it's also the king of cash flow. If you're looking for affordable cash flow properties, it's hard to beat Memphis. Get your portfolio rocking and more cash flowing your way by calling Terry Kerr at Mid-South Home Buyers. Terry's the king of turnkey properties. Contact Terry through the resource section at realestateguysradio.com. And be sure to order Terry's tips for turnkey rental property investing report. It's free. Just send your request to turnkey@realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
Hey, it's Ken McElroy. I listen to the Real Estate Guys, and so should you.
Welcome back to the Real Estate Guys radio program, heard every weekend on this great radio station, all the time at realestateguysradio.com. We're talking about how to spot trends in a market and what that means to you as a real estate investor. And the gentleman you're about to meet does a lot of that, and you'll see why he needs to. Please welcome to the Real Estate Guys, Mr. Aaron Adams. How are you, sir?
Thank you very much. I'm doing great.
It's great to have you here. I know you've done some radio in the past, so you should not be a foreigner to the microphone.
Nope, I'm comfortable. This is great being interviewed as opposed to being on your side of the mic.
There you go. Well, Aaron, tell us first, so people have a perspective about where you're coming from. Tell us your story. How'd you get into real estate?
I watched an infomercial back in 1999. I was sitting at home at 2 a.m. and probably shouldn't have had the TV on, and a guy named Carlton Sheets was pitching his No Money Down program. I ended up buying the eBay version for $100 because I couldn't afford the $4,000 version. And started watching those tapes and listening to them and realized how confusing it all was and how real estate's really a different language. I went to Barnes & Noble, bought every book on the shelf, and the first one that I read that had the nice pictures and was pretty thin was Rich Dad Poor Dad. I lost sleep from that book, and ironically, I was teaching high school at the time, and so I went out and got some education. I went and paid for a boot camp in Riverside, and it was about flipping houses. I paid, for $1,500 for a weekend training, and went out and bought a duplex. And my wife and I moved into one side and rented the other side out. Now, we were lucky, but being in a good market and taking action are two different things. So we caught the California run-up in 1999. We bought this duplex for $100,000. It went up $75,000 in 6 months. We flipped it. And high school teacher Aaron Adams, making $40,000 a year, walked out of the title company with his mind blown and a check for $50,000.
Wow.
And so, I reinvested that money into more deals, bought more education, got a broker's license, and over the next 4 years, flipped about 60 properties.
Wow. And now where you guys sit, oh my gosh, you primarily have a property management company and you manage a lot of assets and not just in one state, which is kind of unique. Tell us where you made the jump into property management and why.
In 2004, I got really nervous about the California market because every property that I had purchased prior, I could make at least 8% on the rents. They call it the 1% rule, where the monthly rent is 1% of your all-in number.
Yep.
And when I couldn't get that anymore, I started looking to reinvest because by that time I had made over $1.2 million. And I developed a market criteria of 4 things that I look at. And as I applied it all across the country, the market that made the most sense was Indianapolis.
Wow.
So January 2005, I had divested of all my California holdings, had $1.2 million burning a hole in my pocket with a couple of partners, one of whom was my dad, who matched my $1.2 million with his $1.2 million. In January 2005, I started Alpine Property Management in Indianapolis. A couple of years later, by applying the same criteria, we fell in love with Dallas. We moved into the Dallas market, followed by Kansas City. We were in and out of Orlando. We were back then a couple of years later in Vegas and California, and now we love Charlotte. And so we've taken a very national approach to investing over the past 15 years, and that's resulted in us buying over 5,000 properties.
Well, we always say live where you want to live, invest where the numbers make sense. So let's talk about Indy. That's an interesting place. We had that on our radar for a lot of years as the most affordable market in the U.S., and for a while it was. Of course, prices have gone up there now. But did you have any history or relationships, or you just heard it was a great market and you went there?
It was funny because I grew up in Las Vegas. My dad was a casino executive. I went to high school in New Jersey. He was a casino executive there. By the late 90s, he had gotten out of the casino business and was doing hard money loans. He was doing asset-based lending. So he had about $30 million that he was putting in projects all over the country. It was at his suggestion that I look at Indianapolis because he had grown up there. Now, my first reaction was, no. That's grandma and grandpa. That's the state fair. That's summers in India. I had no desire to do that. But he pointed out that I could preserve the money that I had made. I had made my first $1 million. I didn't want to lose it in California. And at the very least, I could go park that money in properties, and that Indiana has a great government. It's got good population growth. It has low unemployment, and it's a great place to protect your wealth.
Well, that's a interesting point because as you look out there, you've got your mission as an investor to acquire assets that make sense, but so much of what we do in residential property is based on the tenant. Are there good jobs? Are there good school districts? What kind of a level of the strata do we want to be in? When you look at that today, what's kind of the target opportunity property for you guys?
It's really interesting because anybody can make money flipping right now.
Yeah.
We've returned to 2006 numbers in many markets across the country, and so we're at a new high. And a lot of people are wondering, is the market going to crash again? What's driving the market? What's been driving appreciation? But when we look at it again from a very safe standpoint, meaning if I invest for the rental income, no matter what the market does, let's say when and if the market crashes, rents go up in a downturn. They did the last time when I rode the downturn up.
Sure.
Your property value may drop, but if you were making 8% on a $100,000 property and it goes to $60K, rents will go up because rents aren't tied to property values. And so one of the best hedges for investors that we see is rental income. So we look really hard at what's the unemployment rate in a market. We like to see a market that's outperforming its region. We look at population growth. I want to see people moving there. So, just because I can get cheap houses in Detroit doesn't mean that I want to buy rentals in a market that has lost 60% of its population over the last, since the 1960s. Whereas Indianapolis has had a 60% growth rate since the 1960s. So those kinds of trends, that makes sense. You need someone to live in your house. They need to have jobs, are drivers that we really take into account when we're looking at buying a rental.
Well, most property managers tend to be in one geographic area, and it's rare to find someone that kind of reaches out. And normally from the property management point of view, that's because they see opportunity to manage houses. A little different because your perspective is from the investor, and now bringing property management alongside, what made you get into that part of the business as opposed to just fixing houses and holding on to them and selling a few of them?
No one wants to be a property manager. And if little Johnny announces at Thanksgiving that when he grows up he wants to be a property manager versus an astronaut, no one pats him on the head. But you know, what's funny, I was kind of forced into it because my dad said, look, my partners and I won't invest with you in Indianapolis unless we can control our environment. And that means that we cannot outsource. We cannot outsource the management. We cannot outsource the construction. And it just doesn't make sense to outsource the brokerage piece, because if we can bring a deal in and we can control how we buy it and where we buy it and then run it through our own construction company or run it through our own management company, then we can really ensure the viability of that asset. I mean, look, I love Nashville right now. I think it's a great real estate market. It comes up on all of our metrics as an exciting place to invest. But until I have a team in place, that's half the battle.
Right.
And so I always worry about working with a group that outsources part of their operation. Not that it's a bad thing and not that they don't have good partnerships, but it creates a volatility point. Because if I buy a house from you and then you say, hey, here's my friend Jeff, he owns a management company. Jeff hasn't made any money off me yet. And he might be indirectly incentivized to try to monetize that relationship. And so when we made the decision to go into Dallas, it was only with the agreement that we would find a local operator, partner with them, set up the management company, set up the construction company, set up the brokerage. And as we've moved in and out of other markets since then, over the last 12, 15 years, that's always been an internal requirement. It's a lot harder. It takes more time. I mean, I've taken the broker's test in different states more. You know, the last time I took it in North Carolina, it was confusing because states have diametrically opposed rules. So I struggle with that. But it's allowed us to really hit our numbers when we do go into a market and then when we sell those properties to our investors.
All right, good stuff. Hey, let's talk about the trends. I know you're always out there looking and studying the market, and obviously you've given us some of the metrics you look for. But this year in particular, beginning of the year, you started to notice a few things, and you've put this together in a really great report. And I wanted to make sure we can share this. So before you're done, we'll give you a chance how to get your hands on a copy of Aaron's report. But give us the high level. What are some of the big trends you're seeing now as we're in the year of the new president in front of us?
You know, it's interesting. If you think about the stock market since over the last 8 years, it's been going up, up, and up. But if you look at housing in this country, it's been going down, down, down. That has never happened before. If you look back at the last 100 years, whenever the market took a rise, home ownership was right there with it. They were metrics that matched each other.
Yeah.
For the first time in over 100 years, we've seen the reverse. So homeownership has continued to drop since the crash, almost inversely, and we're now at almost a 100-year low for homeownership in this country. And people are kind of scratching their heads going, why? And so last year in December, I spent 100 hours doing empirical study and research that we've put together in this report for you, where we bring all of our 6 conclusions together about the market, and they encompass and answer some of those questions.
Yeah, it's awesome stuff. And we're not going to get to all of it today, but let's hit some of the high notes. What are some of the trends that you see? And more importantly, how does that relate to the listener who wants to be on the real estate investor side of things?
So I've been saying, as I've met with investors all over the country recently, that there's never been a better time to be a landlord. So think about it, more than ever, we're becoming a nation of haves and have-nots. And if you're a have, meaning you have money in a retirement account that you can use to buy a rental property, or in a savings account that you can use to buy a rental, or on a line of credit that's just sitting there not making you any money that you can use to buy property, there's never been more tenants. As the homeownership rate has dropped to a 100-year low, that means that people are renting. The largest group of renters by population in this country are the 40 and olders.
Yeah.
That's significant. Millennials, in 2015, 40% of the millennials, the 18 to 35-year-olds, were still living with mom and dad.
Wow.
That's significant. And now you can go back and look at causation, but at the very most fundamental level, our young people and our older people are renters.
Yeah.
Now we get him the why behind that, but that's good for you as a landlord. And Wall Street agrees with us. Many investors don't realize that in 2012, for the first time ever, with Warren Buffett going on CNBC and saying, man, I'd love to buy a couple 100,000 single family homes.
Yep.
That for the first time ever, Wall Street got in the game, and they've bought billions of dollars of property in this country, and that's unprecedented. And so now if many of you live in neighborhoods where the home down the street is a rental that's owned by a Wall Street fund. Why is that significant? Because Wall Street and their number crunchers agree that being a landlord, especially in single-family homes, is a great place to park your money, especially with the market many thinking is going to crash.
Well, that's a good point, and you have a unique perspective on that. It's not just that you've researched that, you've actually worked with a fund that's acquired property. Tell us just a quick side story and talk about that part of it.
It was interesting because from 2000 to 2012, I learned to buy properties at the auction. We learned to send out letter campaigns that market to investors. And when I would go to the auction, it'd be like Billy Bob who buys flips on the south side and Mark who buys rentals on the north side. And it was very much a mom and pop business. And we were kind of like down there with the mobile homes in terms of respect and credibility in real estate.
Yeah.
In 2012, almost $20 billion was allocated to buy properties. And I get a call from some Wall Street guy who had worked for Lehman Brothers, Putnam, and he said, Aaron, I want to buy your operation. And I said, why? And he said, because you're in Kansas City and Dallas and Indy, and we love those markets. And more importantly, you're managing 1,000 properties across those markets. And we feel like the systems that you need to do a good job with that, we don't know yet. There's no precedence for that. So we want to buy the houses, but we don't know how to manage them, because managing 1,000 houses is much different from a system standpoint than managing a 1,000-unit apartment complex.
You bet.
It's like tennis and racquetball. Yes, you got a ball. Yes, you got a racket, but two different sports, and they're not related to each other. And so I wasn't interested in selling. I've rebuffed several attempts over the years, but I was able to partner with this Wall Street fund, and I got paid when I bought the house for them with their money, when I fixed it up for them with their money, when we rented them out. And we've continued to work with those Wall Street funds. In fact, our clients, that's been a source of liquidity for them. The hardest thing about owning a rental is getting rid of it. And we've been able to provide our clients with access to that liquidity. So when we were in Vegas a few years ago, we sold many of our properties to a fund. When we were in Florida, we did the same thing. And now in Dallas, it's something that we're looking at, is potentially selling the rentals. So imagine I sold you a rental in Dallas for $80,000 4 years ago. I call you up next month and say, hey, a Wall Street fund wants that rental property as a rental. They'll give you $100,000. And so that's a very typical thing now that our clients have when they buy properties with us and in our network. And so Wall Street's been great for our clients. And, do I think it's great for the country? I don't know. I don't know if it's going to be a good thing, because it's unprecedented, just like the home ownership rate is unprecedented. And as investors, our job is to look at what's happening, look at the 35,000 foot level, and look for opportunities. And that's what we've done very successfully over the years.
All right, good stuff. Well, I just wanted to point out that wasn't just something that you read and researched. That's something that you had personal knowledge of. And of course, continuing to see opportunity. We're seeing this consolidation happening. And it's because, to your point, Wall Street recognizes this is an asset class that if they can figure out how to get their arms around it, can make sense. For individuals, there's so much opportunity because, as you mentioned, lots of sources for capital, but also individual investors can be more nimble. They can react to these things. So back to the report. Let's talk about another one of the trends you see.
New construction is interesting. And I was at the Joint Center for Housing Studies that Harvard publishes. If you're looking for a place to look at empirical research and look at a 10,000 foot level, Harvard, absolutely free, offers their nerded out 30-page PDF with graphs and charts. And I spent a lot of time there looking for data and looking for trends. And I was fascinated a report that was published in December about new construction in this country. And there's a pretty predictable amount of houses that we need every year in this country, and it's about 1.7 million.
Yep.
To keep up with immigration, to keep up with demand, properties that get torn down, younger generation buying homes, we need about 1.7 million. However, builders very rarely match that supply. And so, looking back to 1980, we almost had a perfect match of 1.7 built, 1.7 million demand.
Yep.
But very rarely has it been the case. And here's the disturbing trend. Looking back for the last 8 years, we're underbuilt over 4 million homes. Now, what does that mean as an investor? Well, it means that there's never been a better time to become a landlord in the blue-collar, lower middle-class segment of the market. And we don't typically sell investors low-income, war-zone, high-crime neighborhoods. We like to be in the blue-collar because that's where all of the entry-level home buying is taking place. Now, I've been doing some building over the past couple of years out on the West Coast, and it's interesting as a builder, we bought 11 acres and we said, should we do quarter-acre lots or half-acre lots? And you would think quarter-acre lots, which is double the number of homes, would be more profitable, when in fact, that's not the case at all.
Right.
For a beautiful thing called upgrades.
Yep.
And when people are buying their second, third, fourth home, they buy it for $400 and they end up spending $100,000 in upgrades.
Yep, which are generally more profitable than building the house.
Absolutely, like 100% spread.
Yeah.
Well, let's not talk about that because I'm
Right,
still
no.
selling some. And so where we're most underbuilt in this country is in that entry-level home market, and those are the rentals that we sell to investors. We're 4 million homes short And whereas, I mean, it's really disturbing that in 2006, before the market crashed, we built 2.1 million. So we had this huge surplus.
Yep.
And that's one of the drivers that caused the market to crash. So when people say to me, do we see a crash coming again? I point to that and say, until we've caught up with the demand for inventory, I don't think it's going to happen. I think that we're still several years away from the market crashing, the real estate market crashing. Now, if the stock market crashes, which it could very well drag down some property values. But like I mentioned earlier, the stock market has already completely disconnected from home ownership in this country, and they aren't really metrics that can be tracked parallel to each other.
Well, not only that, the real estate market, the real estate asset class is not voluntary. Nobody ever has to invest in a stock or a bond or a piece of silver. Everybody has to have an economic exchange with real estate. Even if you live under a bridge, that's an economic exchange with real estate. But if you're going to rent, if you're going to own, all those things make sense. And today we see the demand increasing. In fact, I remember recently after the crash, we had an article that was in our workbook for our field trips for a long time about the coming shortage of homes. And back then, nobody could believe there'd be a coming shortage, right? There were hundreds of homes vacant in every neighborhood. But it was the exact math you talked about, that if you put the trajectory out and the fact that builders have not historically kept up, we are heading towards a housing shortage. Not only that, because of the markets you pick, what's great about blue-collar neighborhoods, besides the durability of the rent, is the fact that despite those tenants can be hardworking folks, they rarely find themselves in a position to be able to buy. Even though it's affordable, they can't scrape together the 20%. They haven't kept their credit in line. They make good tenants. They may never be owners.
That's a great point. In fact, Yahoo had a study that came out a couple of months ago. I didn't know they were still a website. I thought somebody had bought them. But they had a study that said 86% of renters either don't have the credit, the down payment, the debt-to-income ratio required to get into a mortgage. Now, lending standards have really kept a high bar since the market crashed. Dodd-Frank was passed for that express purpose. Who knows what will happen if Trump is able to unwind to that, but as an investor, it's something I'm watching. But that being said, subprime loans, liar loans that were very common in 2006 that allowed a lot of people who maybe didn't have the debt-to-income ratio, maybe didn't have the credit, maybe didn't have the down payment to become homeowners. And so that's kept a huge segment of our market on a national level out of home ownership. So what we've done in each one of our markets is we create a program, we call it our 5-on-5 plan, where we sell you an investor a rental property, you keep it rented for 5 years, and at that point then it converts to a seller finance deal to your tenant. So, you already know what kind of person that tenant is in terms of how they take care of the home. You know what kind of payment person they are in terms of how well they pay their bills. And so even though that tenant may not qualify for conventional mortgages, we have set up a loan servicing company in each of our markets. And so we'll take your property, you go from being landlord to banker, and you're locking in that appreciation. So imagine you buy a house for $60,000, you're making 8% on the rent, you're getting that money every year, whether it's owned by you or your retirement account. And then in a few years, we come to you and say, hey, the tenant wants to buy it for $75,000 at 7% interest. You're stretching out your capital gains. You're making a high interest rate just off the mortgage. The tenant now is in charge of the repairs. The tenant's in charge of the taxes and insurance, and you're just collecting a check every month. And we find that liquidity is phenomenal for our investors, but it's been a great service in those communities for those working class and middle class tenants.
You bet. That's great. And in fact, here's a tenant you have known for all this time, and they just need a little hand up, and that's a great win-win. So we're talking to Aaron Adams today about some of the trends that he sees out there, and it comes to especially single-family investing. We'll continue to look at some of the points in his report. We come back. Plus, we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
If you want to retire in the next 5 years or less through real estate, then please pay close attention. My name is Brad Sumrock, and I've taught thousands of my students how to replace their incomes, quit their jobs, and retire faster than they ever thought possible by not investing in single-family homes. You see, there's a secret to retiring fast with little risk, and it has nothing to do with being a landlord, fixing toilets, or flipping houses. The secret is multifamily apartment buildings. Starting from scratch with zero experience, I managed to pocket over $1 million in cash and retire from my 17-year corporate job within 3 years of apartment investing. Now, this is not your typical no money down real estate training. We believe in smart, hard work for intelligent people. So if you're good with your finances, have a decent job, or saving your money, and you're looking for a change and getting out of the rat race, then investing in apartment buildings might just be the answer you've been looking for. Send an email right now to sumrock@realestateguysradio.com to get the details of my upcoming training event, and you'll also receive my free training webinar, Apartment Investing for Beginners. That's Sumrock, SUMROK, @realestateguysradio.com.
Hello, I'm Herman Cain, and you are listening to the Dynamic Real Estate Guys.
Welcome back to the Real Estate Guys radio program. I'm your host, Robert Helms. We're talking about hot trends and demographics, especially when it comes to single family. We'll get back to our interview with Aaron Adams after we play Real Estate Trivia, your chance to win a prize by knowing today's Real Estate Trivia question. In just a minute, I'm going to ask you a question about one of the markets he talked about, and you're going to give me the answer. And the quicker you do so, the better chance you'll have of winning our prize. All you'll do is listen to the question, and if you know the answer, send an email to trivia@realestateguysradio.com, trivia@realestateguysradio.com. Include your name and your mailing address, plus the answer to the question. And if you're the winner, you're going to get a copy of Passionistas, Tips, Tales, and Tweetables from Women Pursuing Their Dreams. An awesome book. You're going to love it. Last week on the Real Estate Guys, it was part 2 of our Summit at Sea adventure with a whole bunch of great faculty. Our question was, Cozumel is Mexico's largest permanently inhabited island off the eastern coast of Mexico's Yucatan Peninsula. What does the name Cozumel mean? It means land of the swallows. Legend has it that all Mayan women made the journey from the mainland to the island at least once in their life, and as a gratuitous gesture to the moon goddess, they released flocks of swallows on the island each spring. Cozumel is land of the swallows. Here's our real estate trivia question for this week. Aaron talked about the market of Charlotte. In fact, Charlotte is the largest city in the state of North Carolina and the second largest city in the southeastern United States. Here's our trivia question. Which southeastern U.S. city is the largest? If you think you know or want to take a guess to the largest southeastern U.S. city, send that to us along with your name and your mailing address to trivia@realestateguysradio.com. The first person with the right answer will get a copy of Passionistas, Tips, Tales, and Tweetables from Women Pursuing Their Dreams. That's today's real estate trivia question. We're talking with Aaron Adams. He's a property manager, real estate investor, turnkey operator, you might say, in a whole bunch of different places. And we were talking about these various trends. Now, Aaron's put together all of these in a report where he'll get into more of the details, and we'll show you how to get that before we're done. Aaron, after you look at this kind of information, and now you're trying to say, how does it fit in what I'm doing now, the markets I'm in, and so forth, where we sit today, what are the markets you like?
So Indianapolis was our first market, and since I didn't come from Indianapolis, we haven't been married to that market. When insurance in Florida for $100,000 in insurance went from $600 a month to $1,200 a month, that kills the cash flow on a property that's rented for $800 a month.
Right.
And so we made the decision to exit the market. We have clients all over the world that have bought properties from us. So 4 years ago, I had a call from a Singaporean that says, I want to buy a rental in Indiana. And I said, I know I'm an ignorant American, but is Singapore a country or a city? And and they laughed. They're like, no, it's both. And I said, oh, good. I don't sound that stupid. Yeah. But I said, why is a Singaporean, on the other side of the world want to buy a rental in Indiana? And they're very savvy investors. Long story short, we've sold hundreds of properties to investors all over the world. So I've been to Hong Kong, I've been to the UK and Canada, and we manage those properties for those investors today. But for me, you've heard the quote, they say when your cabbie is giving you stock tips, it's time to sell your stocks.
Yeah.
My rule of thumb is when I'm in Hong Kong and the Chinese ask me about a market, it's time to sell that market.
Probably on the backside, yeah.
Because I have found that the Chinese investors are some of the savviest, most risk-averse investors in the world.
Yeah.
I've been in a room in Hong Kong and they said, all right, let's do 10 properties to test this out. And I can't get someone from Chicago to buy a rental in Indy because it's too far away. Yeah. I find the irony of that, constantly amusing. But the Chinese have a huge appetite for U.S. properties. They like the dollar. They like the market. It's actually very unique that any investor all over the world can buy property in the U.S. and can get insurance on that property. That's a unique aspect of investing here. And so when I was in China a few years ago, a few years ago, they started asking me about Florida. I knew it was time to sell Florida, especially with property, with insurance being higher. A year and a half ago, they were asking me about Texas. Now, I've loved Dallas. Dallas has been one of the highest growth markets, which is an important criteria. It's been a high appreciating market. It's been great cash flow. I still love all of Texas today for business. But when the Chinese have made a huge push into Dallas and into Texas, that's when I think it's time to sell. And so we're actually advising our clients to do that now. Whenever we sell a rental for one of our clients, their next question is, what's next?
Right.
And where are we going next? And so I mentioned earlier that we're looking at Memphis and we're actively trying to put together an agreement with an operator that we love. But we moved into Charlotte a couple of years ago, and actually my partner in Charlotte, Travis, is a huge fan of the show. And he was really jealous that he couldn't be here today because he's been listening to the show for years, and Travis and his dad are from Charlotte, and his wife, Malou. And, as I met with them, I said, why Charlotte? What do you love about Charlotte?
Yeah.
Well, one thing I didn't realize before we started investing in Charlotte is it's the largest banking center outside of Manhattan.
Oh, my gosh, yes.
And I didn't know that. I mean, I knew there was a lot of big banks there, but I didn't realize it was that high. When I looked at population growth, I was floored because it's been number one in the country. When I looked at appreciation of property values, I was floored. It's been the same. They have a great diversified population and workforce. The city itself has been incredibly proactive, especially in the downtown area, about revitalization. We've been heavily investing on the west side of Charlotte because with light rail wedged in between downtown and the airport, it was an area that used to be low income that's just exploding, and so we've done really well there. Charlotte's the second fastest growing city in the country. The population growth has been driven by jobs. The other markets that I've compared it to are like Atlanta, which is a popular market, and Charlotte really has outperformed. Just in insurance, which I was mentioning earlier, that same $100,000 in insurance that cost me $1,200 in Florida, I can get for $500. There is no hurricanes that really make it to Charlotte. They don't have the deep freezes. They don't have the tornadoes. And so insurers are happy, and that's a big thing. So we've loved Charlotte. But we've stayed in Indianapolis because Indianapolis has really hit some of those same metrics. I mentioned earlier that population growth, when you compare Indianapolis to the region, it's outperformed all of the surrounding states. But why? Well, healthcare is huge. A lot of people don't realize that not only is Eli Lilly, huge pharmaceutical company headquartered in Indianapolis, but many people have insurance with Blue Cross Blue Shield. Their world headquarters is right downtown. Education is big. In the Indianapolis area, the 2 million people that live in the metro area, there's 3 universities, IU, Purdue, Butler, University of Indianapolis. They all have a presence there, and that's 100,000 students of a 2 million population. We have a lot of rentals that have students, and we found that students are great. Some people say, do they tear the properties up? And I always laugh and say, not when mom and dad have co-signed on the lease.
Right.
Right? When you look at unemployment, sports, largest sporting event in the world. Everybody knows about the Indy 500. And I got to tell you, one of the newest growth, a little secret for your listeners, if you're looking at trends, Airbnb and VRBO, we can do a whole show on those.
Right.
Because a year ago, I didn't have any of those properties, but we've been putting them, not in Orlando near Disney World, we've been putting them to cannibalize hotels. So we've been doing Airbnbs near convention centers, near sporting venues, and in Indianapolis, that's been phenomenal. On the 20 properties that I've converted, I'm hoping to make over $50,000 in rents just in the month of May because of the Indianapolis 500. And so those kinds of trends, those kinds of opportunities have made it incredibly attractive. Forbes magazine a couple of weeks ago named the state of Indiana the #1 most efficient functioning government in the country. Really high reserves, low debt, and that has impact all the way trickling down for investors. The state of Indiana put a cap in their constitution a couple years ago, capping property taxes at 1% for homeowners, 2% of assessed value for investors, and 3% on commercial. That's business friendly. To have an LLC costs you less than $100 a year compared to California's $800. That's business friendly. We can evict a tenant for $250 in 2 weeks and get them out of the property. That's business friendly. Permitting is cheap and not restrictive. I mean, in California, I had to get permits on mailboxes.
Right.
And so when you add all of those factors up, when you really look at state governments, population growth, unemployment, and affordability of housing, those combine to make a great market. And we feel that Indy has just been phenomenal. And that's why we do our event there every month.
Now, let's talk about your event, because you put investors in a room, because I think, like us, you realize that an educated investor can make a lot better choices. Tell us about this event you've been doing for a while.
So the high school teacher in me, even though I quit teaching high school after 4 years, I've never left that desire to teach and be in the classroom. We cap the event at 50 investors a month. because I don't want more than one bus load. We put you on a bus, we take you to Airbnbs and to flips and to rentals, and we teach you about the differences and how to think about them and how a property can morph through all of those cycles over the time that you own it. But then we spend a lot of time in the classroom. I have asset protection experts come in and teach about LLCs and trusts and the kind of insurance you need, and do I need an umbrella policy, and how much liability do I need on rentals? And we have experts come in and teach about self-directed IRAs. Many people don't realize that your IRA or your 401k can own a rental property. It's not a withdrawal where you pay the penalty and then buy a rental. Your IRA goes on the deed. And every month we send hundreds of thousands of rental income to the IRAs for our clients as growth. So you're not just sitting around waiting for the market to go up. And so we have a lot of people who have been buying those properties from us. It's not an investment fund. It's not a partnership. You or your retirement account buys the property from us. And we don't bind you in on a management agreement. It's month to month. There's plenty of other companies that'd be happy to manage your properties for you. And so over those 3 days, we allow people to get educated on owning rental properties and why they should consider owning out of state from where they live. We let them see the markets, meet the team, and do their due diligence. We never sell properties just from a website. I don't have a website that you can go click on. In fact, we sell out every month at the event. And so we've created the event as a way for people to do honest, authentic, thorough due diligence, see the market, and buy deals. And so it's been a great event.
And even though you do the event in Indianapolis, that's not the only market you talk about. If folks come, they're going to learn about the other markets that you're interested in as well.
Absolutely. We've done the event in Dallas. We've done it in Charlotte. We find that people kind of want to see the mothership. They want, it's our biggest market by far. We have 1,500 of the 2,500 properties that we manage in Indianapolis. You have employees that have been working for me 8, 10, 12 years. It's nice to talk to them. We have other investors coming back. Half of the properties we sold last year were to our existing investors that came back to get another one. And many times they come back to Indy because I'm all over the place and it's different every time. And since I'm a lifetime student, I'm always teaching what's the most current info. And so this month we're spending a lot of time on the special report that we're giving to you guys exclusively. And so my clients come back, they reconnect with the team, and they buy more deals. And so we're very conservative and we're very selective about who we allow to come to that event. People can't just sign up for it. It has to be through referral, like through your network or other investors.
All right. Well, before we're done, we're going to tell you how you can get signed up for it and go check it out if you'd like to do that. Plus, you can get the trends report. Let's talk just at the big picture for a minute, because as a guy that manages 2,500 houses, you have a perspective that's maybe a little different, but also what would be interesting, I think, to the listeners to say, with that many properties in those markets, tell us just a little bit about your overall vacancy rate and maybe what the returns look like.
It's such a great question. People always say, well, what's the vacancy? And I said, vacancy can be controlled. If I offer one of my rentals for $1 a month, then I will have zero vacancy. Yeah. If I offer it for $10,000 a month, I'll have 100%. And so one of the things that's counterintuitive to people is they think that when you buy a rental property, you're just a victim to the market. And we've absolutely found that's not the case. We find that the management process is something that can be controlled and really manufactured. So somebody says, well, what's the appreciation rate? And I said, well, if it's subject to the market, who knows what it could be. But when I have a tenant in there, I can make him a homeowner for the first time. We have a pretty predictable 5 to 10% appreciation rate. We try to set our vacancy rate by how we screen our tenants at 5 to 7%. And we hit that very consistently. If you have a vacancy rate lower than 5%, then I think you're not getting enough rent. You're leaving too much meat on the bone. If it gets up to a double-digit vacancy, then the cost to fix the properties up are killing you. The turn cost, as we call them. And so we're rigorous in our screening to hit our targeted vacancy. And we think that, that a 5 to 7% vacancy is what we try to achieve, and a 5 to 7% default rate in terms of evictions is what we go for. We find that people are really happy that, over 90% of the time your rent comes in, less than 10% of the time is your property vacant, and then over time you're able to see a 3 to 5% appreciation rate in terms of the rental income that you're able to get. Now, if the market crashes, then rents will really go up because home ownership will drop even further than it has been.
Well, that's a good point. That's the counter-cyclical part, that investment in real estate can make a lot of sense when things are going well. It's critical when things aren't, because everyone has to live under a roof. And even though, maybe because of affordability, you might take a little bit of a hit, it's a temporary hit, because I don't see a technology coming that's going to eliminate human beings from sleeping indoors.
Yeah, it's funny. Last time the market crashed, people said, I remember it very well, and people said, we have 10% unemployment. I said, we still have 90% employment, and people still need a place to live, even if they've lost the McMansion that they had no business buying. And that trend isn't going to change. And what we saw was a lot of upper income earners drop into middle class housing, middle class earners drop into blue collar. That's why I've always targeted that segment over the years, because I started with this fantasy of making 20% rents on really low income properties until they started going vacant, and I was eating up all of the returns that I had made fixing those places back up. And so that's a real dynamic that we look at and that we control. And we've seen Wall Street has followed that as well. They're not as interested in the war zones, because when the market does crash, the lowest income neighborhoods get hit the hardest with the unemployment rate, and the highest income neighborhoods get hit the hardest with a drop in value on the properties. Think of South Beach. The last time the market crashed, you had condos losing 60, 75, 80% of their value.
All right, this is great stuff. Hey, if you're interested in getting a copy of Aaron's report on trends, we covered a couple of them. There's more of them that are in the report. Also, you'll be invited to, if you'd like to come, to learn more about real estate investing, the way they do it, and see some of the properties in Indianapolis. All you have to do is send an email to trends@realestateguysradio.com. Trends@realestateguysradio.com. You'll get that report. And one of the things I appreciate you did in that report is that you mentioned and sourced the places you found a lot of the information.
Yeah, the history major, the history teacher in me couldn't stomach giving a quote without a citation. So it's very well documented.
It is. So you can, not only that, it's teaching a person to fish, not giving them a fish. You'll be able to see some of the sources that Aaron uses as he does his due diligence and market analysis. Hey, this has been great stuff. We sure appreciate you being on the show today, Aaron.
Thank you. It's an honor, and it's been really exciting.
All right, good stuff. Hey, more when we come back, you're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
This portion of the Real Estate Guys radio program is brought to you by International Coffee Farms, where you can own a parcel of land in your very own specialty coffee farm in Panama for as little as $15,000. Here's how it works. Deeded half-acre parcels entitled Specialty Coffee Farms in Boquete, Panama are turnkey managed professionally on your behalf by a team of local experts. Sustainable average income is estimated at 12%, and cash flow can begin within 12 to 15 months from the date of your parcel ownership. International Coffee Farms' mission is to own and operate specialty coffee farms that are economically, environmentally, and socially sustainable. As part of this mission, 20% of the gross profits of each farm is committed to a socially sustainable fund to improve the lives of the Panamanian coffee farm workers and their families. International Coffee Farms currently owns and operates 9 specialty coffee farms with half-acre parcels available for immediate ownership. To find out how you can become a coffee farm owner in Boquete, Panama, email coffee@realestateguysradio.com. That's coffee@realestateguysradio.com.
Hi, this is Kim Kiyosaki. I'm the author of Rich Woman, and you are listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, make sure you make plans to join us for the Secrets of Successful Syndication. We'll be back in Dallas, Texas in September. If you've ever thought about raising money to do bigger deals, this is the event for you. It's always a great time. All the details on our website at realestateguysradio.com. Great to hear from Mr. Aaron Adams.
Yeah, he's a sharp guy, and I didn't really realize so many things in his background, but the idea of being a teacher, I think there's just something, I think some of the best salespeople, and I use salespeople in a very complimentary way. I think a professional salesperson is in many ways both an educator and a problem solver.
You bet.
And so a great communicator, I thought that was fabulous. And the other thing too is just the impact of the Purple Book. I mean, another Purple Book story. There you go. Guy reads Rich Dad, Poor Dad, has a paradigm shift and goes from making $40,000 a year as a school teacher to becoming a multimillionaire and helping other people become a multimillionaire. It's the generosity Kiyosaki talks all about that entrepreneurs and investors bring to the world.
Yeah, it's huge. And I think really as an individual real estate investor, it's maybe sometimes hard to see the big picture. You're in a market or 2, you have a property manager or 3. Here's a guy that's in lots of different markets, always studying. You heard his history of markets. I'm pretty sure he's not done, right? He continues to look at markets. In fact, we went on to have a great conversation about some of the markets that they're looking at, not ready to pull the trigger. You know, he's in process. But the stuff that he talks about makes sense. You go, well, you know what? Gosh, that makes sense. We're at an all-time low in home ownership. That's a great thing for a landlord.
It absolutely is. And it's also indicative of just there's sea changes. There's this ecosystem that we invest in is changing. There's demographics. There is just societal attitudes. You've got what's going on economically, geopolitically. You've got all kinds of things going on. It's why we do the Summit at Sea. It's like, where do you go to try to process everything that's changing and get different people's perspectives and understand kind of what's going on at the high level, but bring it all the way back down to earth. That's what I said at the top of the show. This is a guy who can see the 35,000 foot view, but also come down to Main Street and actually do deals at the Main Street level. And it's very rare to find somebody that can do that, even in one market, but to be in multiple markets and to manage as much as he's got going. I think he's sharper than just a teacher and sharper than just an educator and a student of history and economics. I think he's also probably a pretty good businessman too.
He challenged my paradigm a bit for sure, because I've always thought that the property manager is arguably the most important and least respected person in the whole food chain when it comes to real estate. And of all the jobs, right? I mean, that was my original door into real estate, was through on-site management of a large apartment building. And I thought, man, this is not a job I want long term. But when he told the story of how his dad and partners had said, no, we need to have control. We need to have the management company. It's like, wow. Now, today where I sit, I would still rather outsource management. But understanding a guy that did it for the visibility and did it for the clarity on understanding the business you're in, that's pretty sharp. Today, hugely vibrant business.
Yeah, well, I mean, I think outsourcing property management doesn't mean you're doing it. It just means they're working for you and you have control and they're accountable to you. And I think that's important. I mean, if you look at critical functions, things that you absolutely have to have in place, you do have to be concerned that if somebody that you're really relying upon goes out of business, decides to sell, goes through a divorce, dies, whatever, all of a sudden you could potentially be vulnerable. The next best thing is to have redundant systems. You got 3 or 4 excellent contractors that you have relationships with. That would be kind of the next level down. So, you may not be able to be there right away based on the size of your portfolio, but when you're looking at who you're dealing with, that's something to think about. It's like, okay, am I dealing with somebody that's just a one-man band and he's got a bunch of people out there that he's aligned with, or am I dealing with somebody that's actually got some staff and some team and some systems and some investments and some control? And I think there's a place for both, but I think ultimately you aspire to be part of something that's a little bit more grounded, a little bit more substantial.
So this wasn't meant to exhaust every trend out there, but certainly you want to get a copy of Aaron's report. All you have to do is send an email to trends@realestateguysradio.com. We'll get that out to you. But I think the bigger message here is to pay attention. It's not a static business. Sometimes we own a property for 5, 10, 20 years, and we tend to think, oh, I've owned that thing forever. The market is changing. The people who are demanding that type of property are changing. The rules and laws and the economics and those things are changing. In fact, next week, I think we'll be talking about clues in the news because there's a lot going on we want to be aware of. But as a real estate investor, it's up to you. No one cares about you and your portfolio more than you do. Make sure you're paying attention to these trends.
Yeah, I think something else that Aaron brought up that is great, in addition to the concept of making sure that you have a great property manager, is the notion of not going into a great market just because it's a great market until you have the right relationships, the right team, the right boots on the ground. This is a guy, it's not like we've been following each other, we've gotten to know each other, but I can see why we get along, right? After the first time sitting down and talking with him, it's like, you know what? You think the way we think. You value the property management component. That's a very important component. We argue that it's the most important component. Second thing is the market's important, but the team is, you can't go into a market until you've got a team. You can't go get a property and then build a team around a property. You build a portfolio around a team. Sounds simple. When you hear somebody explain it, it's like, duh, that's common sense. But I can't tell you how many people we see that go into a market, find a great property, or what they think is a great property, and then turn their problem over and then try and build a team around their problem.
All right, if you're interested in Aaron's research, all you have to do is send an email to trends@realestateguysradio.com. Trends@realestateguysradio.com. Coming up shortly on the Real Estate Guys, it's another edition of Ask the Guys. So if you have a question you'd like to ask the Real Estate Guys that you'd love to hear us answer on the air, all you have to do is go to the website at realestateguysradio.com and click Ask the Guys. Until next week, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers, low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct
asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.